Well, first of all, welcome, and thank you for all joining our September meeting. Before we get started, I just want to say how grateful that we are to see that our Gulf Coast chapter and our Pineville chapter was not significantly impacted by Hurricane Sally. We all know that we have colleagues and friends and family that was in her path, and we will definitely be keeping them in our thoughts and prayers. Hurricane Sally was a unneeded reminder that 2020 has been a year of unpredictability, challenges, and obstacles. And we have been able and lucky enough to really get some of the top industry leaders in here to speak to us and to help us navigate through it all. And out of that group, I would say that our speaker today is definitely at the top of that list. Rebecca Chase with MGIC, I believe, needs no introduction, but I will read the bio that was given to me. Rebecca joined MGIC in 1998 and currently hosts many MGIC national webinar courses along with live sessions. After attending Marquette University, I hope I got that right, Rebecca spent her early years in commercial banking, moved into mortgage lending as an underwriter, and then into production as a loan officer and sales manager. Before joining MGIC's training team, she worked as a senior underwriter. A Midwest native, Rebecca now lives with her husband in Tampa Bay area. In her spare time, she referees college, indoor, and beach volleyball across the country. Rebecca, we are so glad that you took time to speak with us today, and we are all very grateful that you're here, and I will turn the floor over to you.
Okay. All right. Well, we want to thank everybody for joining. And again, thanks to the association for having us. Thanks to each and every one of you for supporting mortgage bankers. I think now more than ever, it's important for your voices to be heard, as we saw with how quickly all of the different groups responded with the proposed increase in fees. And we at least got a little bit of relief there to push that back. We're going to talk a little bit about what the agencies have been up to this year, and they probably feel like a lot of you do, that it's almost been like Lucy and her buddy on the candy line, that you just can't go fast enough with those chocolates going by. And I can't imagine that Fannie and Freddie are not feeling the same way. They have been busy with putting out announcements. We're up into like announcement 38, and we're not even to the middle, really just to the middle of September. So it has been quite an unusual year, and we're not going to necessarily tackle each and every announcement because many of them have been very much focused and related to COVID and how to handle working with the pandemic issues. But we're going to start with just reminding ourselves probably about what seems to be one of the hotter topics as we're working with borrowers' files, and that's for those folks that are self-employed and have chosen to enter into the mortgage application process right at this time, some of the things that we need to look at. And I'm thinking you're all going to agree with me that as we get deeper into 2020, the whole self-employed impact with COVID will hopefully right itself a little bit, because we'll see that businesses will have an opportunity to recover a little bit longer. Then we're going to touch on some of the highlights out of the announcements that Fannie's had issued. Same with Freddie. Give everybody an opportunity to ask some questions. And again, you're welcome to unmute your line and jump in as we go. As well as if there's anything else that brought you to the topic today, let me know. We had several questions that were submitted, and I'm going to start with a couple of the questions right off the bat, and then I'll put some of the other ones into the context of the presentation. One was about flood insurance. I guess that's probably a very timely question, given that it's September and it's hurricane season for everybody. And the question was about whether the agencies will allow private flood insurance as opposed to requiring everybody to be part of the National Flood Program. And the answer to that is yes, they will allow it. And I will personally attest to that, because we purchased private flood insurance and we have a GSE loan, and everything went on just as it should and is in place. So that is available and acceptable to the agencies. The easiest thing, if you want to look at any particulars that I find, If you're not familiar with Polly, not sure how many of you have visited with Polly on Fannie's site. She is their automated artificial intelligence person, and you can ask Polly anything, and she's pretty good at giving you an answer. Bless you, Maura.
Excuse me.
The other question, I hope you're not sick. The other question was that I wanted to answer right up front was about where do we think we're going with the COVID flexibilities, and do we see them staying in place on an open-ended basis? The agencies both, and of course, when we talk about all the COVID flexibilities, Fannie and Freddie are jointly required by FHFA to try to stay in lockstep. Their languages are still a little bit different in the bulletins, but the way they're approaching COVID and COVID relief is the same. Self-employed flexibilities, where we're required to gather additional documentation, P&Ls, bank statements if we've got unaudited, there is no end date to that, as opposed to some of the other flexibilities as the shortening timeframes as far as verbals and things like that, they continue to just extend that. So I think that the additional documentation regarding financial statements is going to stay with us for quite some time. And I think they'll probably take the opportunity to leave that in place. We see that with FHA having been a requirement. So unfortunately, I don't see that going away. So let's talk a little bit about the impact of what COVID has meant for working with our self-employed borrowers. And we've kind of thought about it from what are the steps and what are the order that we would try to take a look at a self-employed borrower, and what are some of the things that we need to think about. And starting with number one is what has been the impact, if any. You know, you've got businesses that we're very fortunate in that it's been business as normal, and or they maybe have flourished. I mean, certain industries have really been in high demand. Then you've got other businesses that maybe fell into the essential category, and so they remained open with just limited capacity. And then you've got those businesses that by mandate or just by circumstances with what was happening actually had to close for a period of time. So how we're going to evaluate that and the stability of the impact on that really comes back to gathering information. And some customers have gone to the extent where they've created a questionnaire for self-employed borrowers to complete. These are the questions and other similar questions that Fannie and Freddie laid out in their announcements that have been updated since the end of May to remind all of us that in order to really evaluate the numbers on the P&L and the numbers on the tax returns and make a credible decision and the best decision about the stability of the income, really have to understand what's the nature of the business, what changes or modifications did they make, and maybe they pivoted totally and changed their product. I mean, we've had some local stories where the business is totally morphed into a secondary product line, and therefore the impact to the business could have been significant, but ultimately it really has provided very little impact. The second part of the process goes along with gathering documentation. And to that end, the agencies have asked, in addition to whatever the required number of personal and business returns would be, 1 year or 2 years, and again, Fannie and Freddie go about the 1 or 2 year determination a little bit differently, is the document expiration dates. I'm just going to use an example here because this is a conversation I had earlier with some customers, also seeming to cause a little pain point, just given the volume and the fact that it's taking extended turn times in order to get all the loan applications through the system, that doc expiration dates can become a little bit of an issue. So if we had an application date in the middle of July, then that is going to tell us that our year-to-date information or our most recent financial information must have been gathered through the month prior to the date of application. Then from there, if our year-to-date financials are unaudited, which they very likely will be, then we're going to need to gather bank statements. 2 months minimum is what the minimum amount of documentation is, and we'll touch on that a little bit to go with that, and that would need to be for the months May and June. and we're going to use those to support and give some validity to the unaudited P&L. So in many instances, that year-to-date P&L that needs to be from the prior month, then it has to be within 60 days of the note date. So this is going to oftentimes drive the expiration date of your documents and or the need to gather additional. That's one of the things that for a lot of loan officers, in talking with them, they've gone ahead and started to maybe prep those self-employed borrowers that they may need to add to the year-to-date information and or gather another bank statement in order to keep the documents from remaining fresh. Cash flow from there, calculate your qualifying income just like you normally would. Go through the same process with that year-to-date information. A little bit more of a challenge because not every profit and loss statement that you're going to be provided is going to align with the business bank statements as easily. You may have to find your way through and identify what's the equivalent of gross revenue, and you may find that in those interim financial statements, there may be very little, if any, depreciation reflected, simply because many times that is all calculated when the information's fed off to the accountant when it's time to do their taxes. So the year-to-date information is about the only thing we can put our hands around, but it's not without some concerns and the potential for it to maybe not be fully in alignment with the information that you would be seeing on the tax returns. Then from there, we're going to take those bank statements and we're going to do some work with trying to validate and at least give us a little bit more comfort to the fact that what we're going to look at from those year-to-date financials and use to give influence to qualifying income has a little bit of substance to it. One of the other things that has come up is that there's not as much universal understanding of what constitutes an audited financial statement as we all might think. I think we all probably would readily agree that the vast majority of the time, I think in all my years, and Maura, you chime in if you want, and anybody else, in all the years I've been around the business, I think I've seen audited financial statements once. And it wasn't because they were audited in order for the mortgage request, it was that they were also in the process of an IRS audit. So we just happened to have audited statements. So the majority of the time they're going to be unaudited. Of course, the concern is, well, you know, people could write anything down. I really don't think most people are going to do that. Most people are scared out of their minds just trying to figure out how to put a financial statement together. And for those sole proprietors, smaller businesses that may look at you and say, I don't even know how to put a P&L together. Again, you know, there's lots of templates out there, as well as a Schedule C is readily available to give some direction if somebody's having difficulty trying to pull that information together. On those rare occasions that you get audited statements, there will be an attestation by the accountants that have done that work. So again, just to remind everybody, just because the financial statements are coming on the accountant's letterhead does not mean they're audited. And very rarely will they be audited. Most of the time what's happening is the business is pulling the information off their QuickBooks, emailing it or securely transmitting it to the accountant who's just dumping it on a template. And there's no more validity to the information than when they pulled it off their books. So financial statements, do they need to be signed by the borrowers? And again, let me see if I can give everybody a little bit of capability. If anybody's inclined, you guys all have the ability to annotate. If you hover over where you have your controls, you should see the option there to annotate. If you click on that, it's going to drop a toolbar on your screen. And then from there, you can click and capture a pointer so that you too can point, draw scribbles, anything else that you want to put on there. I'm going to leave that on in the hopes that somebody's going to join me and participate. Financial statements, do they need to be signed by the borrowers? Of course. Signed and dated, just as we would tax returns and anything else that we need the borrowers to be able to testify if they need to, that was what they told us was accurate information. The question is really geared towards whether in your individual lender offices, you're willing to let that be an at closing condition, or whether that's something that you want to require to be signed at the point of application. And again, there's no mandate by Fannie and Freddie to that effect. That really is again left to the lender, but the expectation would be that they would be signed. Using business bank statements to align with year-to-date P&L information. If you're having difficulty with it, you're not alone. I don't know if that makes you feel any better. This is a real challenge. First of all, if you've got a year-to-date piece of information, let's say, from January through August, and you're trying to align that information just by taking that and dividing by 8 with the expectation that the business bank statements are going to very cleanly and consistently divvy that information up for both income and expenses, that's not very logical. So again, Fannie and Freddie, from a number of calls that we've been on, and probably some of you have joined those same ones, have very much indicated that the intent with gathering the business bank statements is not to go through an exercise and try to align dollar for dollar, money in and money out, but instead to use the business bank statements as evidence that those trends are going in the direction that we're looking for. And then last but not least, where all the fun is and all the subjectivity is, what are you going to do after you get all that documentation pulled together and after you pull all the numbers out of it and bring with it the story about the impact of the business? What are we actually going to be able to use for qualifying income? So this is where, if you would, I'm going to ask you to join me in doing some annotation again and ask you to point at the answer, or you can put the information in the chat panel if you would prefer. Happy to have you join along in any way that you would like, or you can chime in. So what we have here is on the right-hand side of the slide, of course, is the analysis of this S corporation and the accumulation of calculated income from the filed tax return. We only needed to gather 2019's information. And on the left-hand side of the screen, we have year-to-date 2020 for that same business through the first 6 months. And we've gone ahead and applying the same concepts, calculated monthly cash flow from the P&L. So now the question is, what are we going to use for qualifying income? On the right-hand side, we have the $2,879 that was calculated from the filed tax return. On the left-hand side, we've got year-to-date information that is a little bit more generous. So from a qualifying standpoint, if you were lending your money, if you've got your underwriting hat on, or just in the spirit of, well, what do you think we're going to use? Join me some way or another by telling me what you think, either in the chat panel or pointing at it. Which one are we going to use for qualifying income? All right, so what do you guys think? Somebody's going to say, well, they're just going to always use the most conservative. There's that element of it, but the most conservative in this instance is also the calculated, probably prudent decision. So what the agencies reminded us of is that in your analysis and all your gathering of information, if you find that the 2020 income year-to-date, or based on the documentation you've gathered, is stable with what was calculated from the tax returns and or increasing, then you're going to use what you calculated from the tax returns for qualifying. I know there's been a lot of conversation about, well, what if the business was positively impacted, unfortunately, by the pandemic? Can we use the dramatic increase? And of course, the answer to that is that's not filed information. There's no way to really truly confirm that the shown income and shown expenses, unless you want to get into an audited situation, and then you could do it, are going to support that. All right, so here in this situation, we've got $2,879 calculated from the tax return. And on the left-hand side, we've got monthly income of $2,100. Okay, we've got declining income. Of course, the likelihood would be we want to use the lesser of the two, but what we have to remember here, and this is the challenging part, is that it's not an automatic take the lesser and off you go. You're going to use the lesser if that lesser amount that you're seeing in 2020 has stabilized. And that can get a little bit difficult to get everybody to agree on, and it can also require additional documentation. So what I think I've heard from a lot of our underwriting managers and different customers is that minimal documentation of year-to-date P&L and 2 months bank statements probably is going to work when the income has remained very stable into 2020. But when the income has declined and we're trying to demonstrate that it's stabilized based on whatever the circumstances were around the business with the pandemic, that this is very likely you're going to need additional information. Either you're going to be asked for additional bank statements, you might need to go back and compare last year's window that you're looking at so that it can be compared to 2020, because we've got to be able to have some sense that whatever that income is that we're going to use, in this case from an unaudited P&L, at least from a supported perspective, that it has stabilized. And then of course there's the unpopular situation where the income is declined and there isn't a picture of stability that we can get into the file. And then the agency's announcement is that income is not to be relied on for qualifying. So again, I think the one thing that is easier for our self-employed borrowers to understand is the ask of 2020 year-to-date information. It is additional information and it is mandated, and it may not necessarily be crystal clear on your automated underwriting system results because of it falling into a COVID flexibility, but that is mandated, and it's the case for every situation. It's not, we can get the P&L sometimes and we don't have to get it other times, unless you're putting things into portfolio and you've got some other different guidance there. So one other scenario I wanted to pull out is one that we see and I've heard described and asked of Fannie and Freddie on a number of different calls is, what about the situation where in January and February the business was cooking along business as normal? You know, income was very stable, likely going to have an improvement from previous years. And then breaks went on and they actually were required to close. And now slowly they're starting to work their way back, and the limited information we may have, and maybe even if we add a third month, is supporting that amount that we see there of $3,000. The question that gets asked all the time in this situation where we have 6 months of information is, can we just ignore March and April and divide all that by 4 and give the benefit of that calculation to our borrower towards qualifying? And the answer to that is unfortunately no. March and April did happen, and part of the reason with any kind of variable income, such as self-employment, that we look at a broader window is to kind of account for the ups and downs. Just never have we seen such extremes. However, if you divide all of this by 6, that's going to be more conservative than if you went after saying, but we can see that May and June is very close to what they started out with. So this is where lenders have flexibility, and this is where additional information might be beneficial. If we were looking at this file and we were really struggling with income from a DTI, which would be the only reason we'd really be having the conversation, if we could add some additional year-to-date information and that supported what we were seeing in May and June, we could probably document, assuming there's not significant other risk factors in the file, and rely on that $3,000 trend, which is going to give us a little bit more room than if we have to average it across the 6 months. So that's where additional documentation, while many times it feels it's just painful, but in these circumstances where we're really in the weeds trying to understand the amount of impact and how successfully and where the business is in its recovery, the additional information can really be beneficial. And one of the other scenarios that we'll touch on, I think it's next here, is this particular question about a cyclical or very seasonal basis. So this comes right out of Fannie and Freddie's FAQs. They now have FAQs for COVID that are up over, 150 questions. So they've been busy. What options are available if you've gone through this whole process and the bank statements are not supporting the year-to-date P&L, not necessarily because of COVID, but maybe just because of the seasonality of the business? The classic example that we always end up using is the Christmas tree farm. So if we were to ask a Christmas tree farm in the dead of summer to provide us a P&L and recent bank statements, whether it's COVID or not, that very likely is going to be part of the down cycle of their year, and may be difficult to reconcile with what we saw in looking at the P&L, because of course in January and February they're still reaping the benefits of the holiday season. So what do? This is where, again, there's not going to be black and white. Fannie's going to give the blessing to do this and Freddie's going to say do that, which I know can be very unsettling for those of you that are servicing and just in selling loans into the secondary market, given everything that everybody still is carrying with us from the 2008-2009 timeframe. But the goal of these flexibilities is to give some framework, but to allow the lender to evaluate all the risk factors and document how they arrived at their decision. So in our Christmas tree farm example, this would be a very good opportunity to, let's go back to the same time frame for 2019 when we weren't worried about the pandemic, get the financials, get the bank statements, and then use that prior year's information to compare to this year. And hopefully that will give an option to continue to allow that file to move forward. So lots of flexibility there. Again, both Fannie and Freddie have dedicated pages to the pandemic, not only for the origination side, which is what we're going to stay focused on, but for anybody that's got servicing questions, as well as consumer information. So if you haven't visited those pages, there's a ton of information out there. So before we move on into kind of taking a look at some of the other global announcements that are out there that may have been of interest to us, do we have any questions, or anybody want to share any experiences you're having as it relates to working with files in the pandemic timeframe? I'm just always curious about what you're all hearing and seeing. Anybody? Okay. All right. All right, so a couple of the pieces of information that Caitlin was kind enough to share with everybody came in an email, and we're just going to take a look at it rather than me having made a bunch of slides, which are going to be stale dated. What I thought would perhaps be a better use of our time and perhaps a future resource is to introduce you, if you're not familiar with it, to a document that Fannie updates monthly. And they use the acronym In Case You Missed It. That's what that stands for. And they publish this on a monthly basis. Some things that they've got in here that are very helpful is they've got everything color coded, and you can do some sorting if you open this up online. And then they also give you some of the most frequent acronyms that go through there. So if you're looking for information about what's happened, Fannie has a nice tool out there. The problem is that, of course, it can become stale dated pretty quickly. So, for example, the one that I gave everybody is the August version, which is the most recent version, and took us up through early August. These are the announcements that Fannie has had posted since then. So your In Case You Missed It document that I sent everybody is current with the exception of these few announcements. And again, many times they're just lender letters that are reminding of either extending the timeframes, and we've seen a number of those with the COVID originations, maybe giving information about forbearance or information about fees. Again, now I want to go to, oops, I want to do that. Sorry about that. Let me come over here. I come back here and see some of the same things that we can see for Freddie. Also, just want to share with you a new resource that Freddie recently brought online. It's a client resource center. This is the address for it. And when you arrive there, this is what it looks like. You can sign in. You can set some preferences. So if you want to only see servicing updates, you can. If you want to see only origination and underwriting, you can. And you can also see across the top, they have 5 key areas that they're giving you information about. News and announcements, just you can scroll right through. It puts the most recent information first. So if you think something happened and you didn't get a chance to go read it, you can always find it. Bulletins, the variety of FAQs, and then events that they have going on. So both of the agencies have a lot of good information out there. And what we're going to do now is we're going to go take a look at some of that information. I just have to make sure I can find it. Now, one other thing, hot off the press, for those of you that are living in the servicing world, is that Freddie had an announcement this morning on the servicing side that they are going to be introducing some additional deferral options based on disasters. So as they were talking about in the announcement, with the advent of fire season and hurricanes and everything else that's going on, they're going to introduce some additional forbearance opportunities, and that may be something that would be important for all of you to take a look at, if that is in your bailiwick as far as daily opportunities and daily duties. All right, so what I have here live for us is this document that I was referencing. If you're not familiar with it, there's a couple things. It is an interactive document. So as you go through and take a look at the layout of what all the different changes have been, and as they relate to whether it's a selling change or a servicing change, you have direct links there to help with that. So I just thought we would take a look at a few of these that are out there and highlight those that would have more impact on us from an origination perspective. And again, as you can see, the good news is that aside from a lot of the COVID clarifications, there has not been a tremendous impact of substantial changes on underwriting guidelines. So as I was looking for things of interest to bring to you, certainly the bulk of the announcements that have generated most everything coming forward has been either COVID related or based on the release of the new loan application. So a couple points while we're on that for a minute. If you've started and are involved in working with your loan origination system vendor in preparing for the rollout of the new loan application, those of you that work with Loan Product Advisor, you'll know that when you start to work with the new loan application, you'll also be working with a new updated version of Loan Product Advisor, and the feedback results will look different. Fannie has not made any indication, nor are there any release notes posted, that the new loan application alone is going to make any significant changes to Desktop Underwriter or the findings. But as always, we always want to remain current and keep an eye out for that. And as we, and Matt, I didn't see your chat, so let me start here and kind of backtrack a minute. Thank you for that. In that whole conversation about looking at the stability of income and evaluating income that has had an impact and is declining, Again, the message there that I keep hearing the agencies talk about is they're not trying to get out of the self-employed borrower business. If I were a self-employed borrower myself, I might think twice about my timing and maybe I should wait a little bit. But if a business has strong savings, I mean, certainly cash is king in a lot of perspectives, but if they've got some strong reserves and or good accessibility to cash, I mean, maybe just by the nature of what their product is, you can use that, and that's a great point, Matt, as a compensating factor. So the challenge is in trying to help coworkers or teammates that maybe have not been in such a manual, subjective, file by file, it's all going to depend on what the answers are to the question, get a sense of, well, what do I do and how do I anticipate how this is going to work? Obviously, educating them to look broader than just the required documentation and really, almost look at it from their own perspective as a lender, if they had their own money sitting on their desk, and thinking about what are the pros and what are the cons with the scenario that's being presented. And then if they think there's some merit to it, get that documented. And there are lots of files that are being looked at very closely, not to necessarily decline them, but to try to figure out, because it's a make sense in your mind, how do we get that documented? So I think that this is an opportunity for those of you that are in the origination world and or are influencing originators for what feels like many times an originator not having a tremendous impact on income calculation. This is an area that I think that the cover letters and anything relating to the impact or lack of impact can have a huge, huge difference in how those files are calculated. Okay, I want to take a look at a couple things here. Again, there has been, I wanted to just come with rental income calculation. Sometimes when you look at this and glance at this, you're thinking, oh my gosh, I don't remember this. What is she talking about? I didn't remember there being a change here. Several of these, okay, as it relates to rental housing calculations and things like that, it's things that you've long been doing. So if you've got rental housing, the borrowers, and it's a second home or an investment property, you have to make sure, as you already are, that their primary housing expense or their principal residence costs are being included in the calculation of the DTI. Some of these, it's apparent that they came from probably there being challenges in repurchase situations and the agencies realizing they needed to kind of shore up some of their language. Wanted to come over here and get up here. Hold on. I had this where I wanted it, and now I can't find it. There we go. Okay. So what's happened since that last was updated? Appraisal requirements, and again, I think we're all familiar with the flexibilities that COVID brought and how that's impacting it. And again, it seems like that is making an impact in a little bit of flexibility in the turn times. But one of the things here that in 2020-05, which was at the beginning of September, and if you haven't had a chance to look at this one, there are a couple things in here that will be of interest. A manufactured home is now eligible to be an accessory dwelling, which heretofore had not been. And in certain parts of the country, that's pretty common. And so that may have been a challenge in previous loan requests, but you're finding that they've opened that up a little bit. And then beyond that, you can see there were just a few things here. Poly, if you haven't introduced yourself to Poly, there is Poly and all that goes along with that. All right, let's move over here and take a look at Freddie. And again, they don't have that nice, neat list. But what I did was go out to the Resource Center and sort by the selling guides and just put in date order those announcements. And I wanted to have us take a little bit closer look at Freddie's most recent announcement, because there's a couple things in here that I think would be of interest to us.
Rebecca.
So let's see, why is, yes.
Are we supposed to be
Are
able
you
to
not
see?
seeing my screen? Ooh,
No,
you're
we're
not
just
seeing my
seeing-
screen.
Nope, we're
Uh-oh.
seeing each other.
Uh-oh, hold on. Let me come back. Thank you. Okay, now are you seeing my screen?
Yes, ma'am.
Thank you. Sorry about that. Woohoo! I'm glad you said something.
Everybody was looking at me for a minute
Everybody's like going, Maura, do something. There we go. Okay, so we can see how the Resource Center works. We click on the guide bulletins, and it's going to take us to the most recent listings. And I want us to take a specific look at the one that came out on September 2nd. If you've not noticed, the agencies release announcements routinely at the beginning of the month, unless there's something atypical that needs to be looked at. And they are also very much loving doing videos. So if you don't want to read, you can click on the button and find out some information about that. But I want to call out the attention to Social Security income. Freddie made an announcement and is going to give some leniency that if you're using Social Security as qualifying income, that you can gross that Social Security up 15% without going through the exercise of having to document that all of it or what portion of it is non-taxable. So that means that could be a much simpler exercise. You could take the awards letter, gross it up 15%, use that for qualifying, and you would not necessarily have to go through the exercise of gathering tax returns and figuring out the percentage. If you need more than that, you can still go through the process of documenting what percentage is taxable or not, and then the non-taxable portion, once that's fully documented, can be grossed up 25%. So that was an area they made a little bit of clarity on.
Is that across the board change, or did something, it's not COVID related?
It's not COVID related. That was an across the board change, and only Freddie made that change. There's been no movement yet from Fannie in that perspective. Okay. The other area that they had an update on was how they're handling gift funds that are coming from a wedding. So I know this is usually a hot topic in the summertime, maybe not so much this year, but as you know, Freddie has always had specific language when we get into the challenge of what constitutes a large deposit and what about the cash that came from the wedding and can we tie that all together? And yes, you have been able to tie that all together with evidence of the event itself. What they've done is, instead of all of that having to be deposited within 60 days of the event and evidencing it with the marriage license or the certificate of ceremony, you can push that out to 90 days. So there's one thing that they actually pushed out a little bit further. As it relates to appraisals within this same announcement, and again, these are non-COVID enhancements or non-COVID changes to the basic selling guides. Initially, this caught my eye, and it's not effective until early in December. And it talks about they're analyzing and making changes to how they're going to report the neighborhood section of the appraisal report. Really just giving some clarification, not anything substantial there. But if you get questions on it, or if you have appraisers that are concerned about what's happening there, that's the language so that you can see it in writing as to what that was. All right. And then again, as you can see from a Freddie perspective, One of the other areas that both of the agencies had some clarifications on earlier in the year, and I would remind everybody of, is when your subject property is investment and the ability to use net rental income from that subject. I know Maura has tuned out right now because we're not insuring investment properties. but when your subject property is investment and you need to use cash flow from that subject, obviously, of course, the easiest execution is to qualify with the whole payment and move on. But if you're wanting and needing to use net rental income from your subject, then you need to make sure Fannie and Freddie are not in lockstep in terms of guidelines. One requires the borrower to have a primary housing expense, be it rent, or again, you could probably push the limit there with paying a family member that they're living with. Again, that gets a little gray, but there's criteria in order for you to use the rental income or the net cash flow from your subject. Your borrower's got to have a history, and you may be limited to only offsetting the payment. So that's one change that kind of snuck in there in the middle of when the whole pandemic was first starting back in March and April, and hasn't gotten a lot of airtime. But I know that I've had several times where folks have been kind of bitten by that and not realized there were some changes there. Other than that, the good news is there have been very few wholesale changes that are going to dramatically impact how we calculate qualifying income. The vast majority of times, it's simply going to be related to COVID. And to that end, I'm going to see where we are as far as questions and turn it back over to all of you to finish off your meeting, as well as we have to do the raffle. Okay, let me take a quick look. Maura, anybody chatted with you? Anybody need anything from your end? Do we have any questions? You're welcome to just jump in.
I have not gotten any questions, no. Does anybody want to open their mics and add anything? I'd love to hear specific scenarios. That would be really helpful to everyone on here. I'm sure somebody on here has been bitten by the COVID guideline issues with self-employed borrowers. I know I've gotten several calls myself. Okie doke.
Some of the more challenging ones have been dentists, situations where long-term employment obviously going to recover just based on typically what we would expect, but then the challenge of really getting your arms around that. But I do believe that the deeper we get into 2020, the more beneficial it may be to even, in addition to a year-to-date P&L, to maybe even also gather quarterly statements, because we'll start to be able to see quarter over quarter the recovery occurring. So that could be something that would be beneficial. And I want to just thank everybody. Hey, Matt.
Hey, I have a question, and this is kind of a question that we've been asking ourselves this whole entire year, but do we know what the agency's parameters are to say, okay, COVID-19 overlays have been released? I mean, do we know like what point we need to be at, whether it's the number of cases or, you know, the states, how they reopen? I mean, do we know any indicators? What are their indicators to know, you know, kind of gauge when this might have some sense of normalcy?
Do not. And I was on a call not long ago where they were asked that, and the parties that were asked the question, you know, kind of pleaded, not my pay grade type situation, and that they are not aware that the agencies have available anything specific as to what they're looking for in terms of the overall recovery before they eliminate those flexibilities. Now, have not seen anything, have not seen any conversation about it in any trade publications. I was thinking about that the other day, because right now we're looking at an end of September 30th, and I was thinking, maybe they'll let it go this time. Maybe they'll let it go this time, but they've been waiting a little bit later into the month before they extend it. So we'll have to wait and see. But no, I wish I had something to help out with there.
It's good to know that we're all in the same boat on that one, at least.
Well, that is the one thing, is that everybody's swimming up that same stream trying to make this whole thing work during that time frame.
Well, Rebecca, we know the questions. This was, I mean, we all knew it was going to be great, but this was a ton of great information. I think it's always easy as loan officers, especially, to not ask why and just to do it because underwriter or management tells us. But it's always nice to know the why behind what we are asking our clients and be able to explain that not only to our clients but to our referral partners. So that's what was my biggest takeaway from this was the why behind what we're having to do, what we're doing right now. So thank you again so much for taking your time. As a small token of our appreciation, we'll be sending you some nice little gifts, some art from our some of our famous art seekers at the Mustard Seed, and we just hope that you enjoy having a little bit of Mississippi in your office or your home as much as we've had enjoyed you being in Mississippi. So thank you again for this great presentation.
Thank you so very much. Oh, thank you so very much. And thank you, everybody, for taking the time out of your day to join. And Matt, thank you for the kind words. And thanks for thinking to ask us.
Rebecca,
it's all yours.
I have a question for you that's self-employed related, but not COVID, that hopefully will be helpful to the group. I had a loan officer call me this morning, and he swears his underwriter says, even though his borrower is self-employed, do you have W-2s? Yes, I do. Well, you're fine, go. All you need is W-2s. Well, of course, he submits the loan. This guy owns 5 businesses, and he has not asked for one business tax return. So I didn't ask him the reason why, but isn't the reason you have to have the tax returns to support what's on the W-2, that the business can continue to pay that? Is that right?
It is, and I always go back to, if you're a card player, if a borrower meets the definition of self-employed, then that trumps anything else as it relates to documentation. And so whether I'm self-employed and I get paid with a W-2 is no more stable than if I took money out of the kitty, because I could make that W-2 be essentially anything. And a lot of times those W-2s are generated late in the year based on tax liability. So the thought behind not necessarily taking a W-2 alone, if your borrower is self-employed, is that we need to look at the business holistically. And there's no more stability to a self-employed W-2 than there is to a borrower, that is running a Schedule C and a sole proprietor. So you're right, Maura. The variability of a borrower having ownership in a business, that likely statistically the borrower's income is going to ebb and flow along with the self-employed business. That's why I'm not aware from an agency perspective that they are allowing W-2s for self-employed borrowers alone. I think there may be some mixing of guidelines there in thinking that was the case, would be my thought. But yeah, you're spot on that. If they own 25% or more of the business, they're self-employed, and that's going to trump everything in terms of documentation.
Okay, thank you.
Sure. All right.
So thanks for helping us out today. As always, an awesome presentation. And for everybody that's joined on, I hope you found it worthwhile and valuable. If you do have questions that come up on this topic that you'd like to ask after we conclude here, feel free to email them to me, and I'll ask Rebecca, and she'll respond to it. That will not be a problem at all. She's always accessible for us, or our underwriting manager as well. Thanks for everybody today. Appreciate being with y'all. Call me if I can help you. I know I can't be out there making sales calls, but I'm a phone call email away, and hopefully I can get back out there soon. We will see. But Caitlin, I will turn it over to you. Macy, I forgot about Macy.
Yeah, did Macy is our other sponsor today, Mississippi Home Court. Macy, do you want to say anything?
Hey y'all, just wanted to thank y'all for being on the call and letting us sponsor. I do want to hit quickly on the HAT program, the Housing Assistance for Teachers, because it has recently had some very big changes. So check our website out on that. The biggest change is that it can now be used with FHA and USDA, where previously you could only use it with Fannie Mae. So huge news on that. Like I said, go check our website, or you can email me if you have any questions. If you're not a participating lender with Home Court, you can use that program. You don't have to be signed up for our stuff. So just wanted to hit on that. If you have any questions, just let me know. Thanks.
Macy, Mar, thank you again both for sponsoring today's meeting. Again, I think it was a fantastic. We've been really lucky again this whole entire year getting some fantastic speakers, and it's not possible without sponsors like y'all. So we really appreciate your leadership and your willingness to help us get those speakers. So I just have a couple of quick announcements before we do the wheel for the door prizes. November will be our annual membership. We will be doing it via Zoom. Right now we have the nominations open for the yearly awards as well as the charity nominations. So please look out for emails from Caitlin about that. So we will be sending out the dates for the October and November meetings here in the next few days. So other than that, Caitlin, I think we're ready to spin the wheel.
Right, first winner is Ruth Phillips. We'll do.
Congratulations, Ruth.
And Lori Parkman is our second winner. And so we will reach out to you guys and get those prizes over to you.
Congratulations. Again, thank you for everyone for taking time to be with us today. I know that everybody found it very educational, and I hope everyone has a great day, a great end of the month, and please stay well out there. Until next month.